Hello, and welcome back to Algobot, your home for clear, practical breakdowns of automated trading strategies for MetaTrader 5. I'm your host here at Algobot, and today we're examining an expert advisor called Liquidity Trap Zone Breakout. This is a volatility breakout strategy designed for fast-moving markets. Over the next few minutes, you'll learn how it detects a tight, coiling range, how it reads a buildup of tick volume, and how it looks for a decisive breakout bar backed by expanding volatility and volume. By the end, you'll understand exactly how all the pieces of the logic fit together. Let's get started. Liquidity Trap Zone Breakout is an expert advisor built for high-volatility instruments, the kind of markets that can swing sharply from one bar to the next. Think of pairs like the British pound against the Japanese yen, gold against the dollar, or a lively index contract, typically on intraday timeframes from 5 minutes to 30 minutes. That said, the strategy is fully timeframe agnostic, so it runs on whatever chart period you attach it to. At its core, this approach combines three ideas: a measure of volatility, a measure of participation, and a measure of price structure. For volatility, it uses the average true range, or ATR, which captures how much price typically moves in a single bar. For participation, it reads tick volume, which reflects how much trading activity is flowing through the market. For structure, it maps out a horizontal price band, a compression zone where price is coiling sideways. The central idea is what the strategy calls a liquidity trap zone. In a volatile market, price will sometimes stop trending and squeeze into a narrow horizontal band, even while each individual bar is still moving a lot. Activity piles up, and a dense cluster of protective stop orders tends to build just outside both edges of that band. When one edge finally gives way, those orders are activated in a chain reaction, and traders on the wrong side are prompted to close out into the breakout. The strategy aims to be positioned as that fast, one-sided move begins. Because it waits for a specific, multi-part confirmation, this is a patient, rules-based approach rather than a constant, in-and-out style. It's best suited to traders who want to study how volatility compression, volume, and breakouts can be combined into a single automated framework. Remember, this is educational information only and not financial advice. Let's walk through the exact logic the expert advisor follows. Everything is evaluated once per newly closed bar, so the strategy never acts on an unfinished candle, and it holds only one position at a time per magic number. The first condition is the trap zone itself. The strategy looks back over a window of bars, 20 by default, and measures the height of the price band, from the highest high to the lowest low. It compares that height to the ATR. The zone only qualifies when the band height is small relative to volatility, specifically when it is no wider than the compression factor times the ATR for by default. In plain terms, if the market is swinging a full ATR of range every bar, yet nets only a few ATRs of total range, price is coiling rather than trending. That's the setup the strategy is looking for. The second condition is a volume cluster. The strategy measures the average tick volume inside the zone and compares it to a longer baseline window that came before the zone, 40 bars by default. The zone only qualifies when its average volume is elevated, at least the cluster factor times the baseline, 1.15 by default. Rising participation while price goes nowhere suggests capital is being absorbed and, in the strategy's language, trapped. The third condition is the breakout bar itself, and it must satisfy three things at once. First, the freshly closed bar must close beyond the zone edge, above the top for a long or below the bottom for a short, clearing it by a small buffer fraction of the zone width, and it must close in that direction. Second, its range must spike, at least the volatility spike factor times ATR, 1.6 by default. Third, its volume must surge, at least the surge factor times the zone's average volume, 1.8 by default. Volatility and volume expanding together is the signature the strategy is searching for. When all three conditions align, the expert advisor signals an entry in the breakout direction. Risk is ATR-based, so it self-scales to the instrument. The stop-loss is placed 1.4 ATRs against the entry, and the take-profit is set 3 ATRs in favor, giving a reward-to-risk of roughly 2 to 1. And note that ATR is measured on the bars before the breakout bar, so the spike is judged against the quiet zone, not against itself. Let's look at the actual MQL5 code running inside the Expert Advisor, shown here as it appears in MetaEditor. At the top are the input parameters, and these mirror the strategy's settings exactly. You can see zone loopback set to 20, vol baseline set to 40, and ATR period set to 14. Below them are the tuning factors: the compression factor of 4, the volume cluster factor of 1.15, the volatility spike factor of 1.6, and the volume surge factor of 1.8. Finally, the stop and target multipliers, 1.4 and 3, control the stop loss and take profit distances in ATR units. Now look at the long block. The condition reads, if the breakout bar's close is above the zone high plus the buffer, and the close is above the open. In other words, a clean bullish close beyond the upper edge. When that's true, the entry is taken at the ask price. The stop loss is the entry minus the stop multiplier times ATR, and the take profit is the entry plus the target multiplier times ATR. The order is sent with a simple trade by call. The short block is a mirror image. The condition reads, if the breakout bar's close is below the zone low minus the buffer, and the close is below the open, a clean bearish close beyond the lower edge. The entry is taken at the bid price. Here the stop loss sits above the entry, and the take profit sits below it, again scaled by ATR. The order is sent with trade.sell. Notice that both sides are fully symmetric. The market itself chooses the direction, and the same volatility-based risk framework manages either trade. Let's bring the whole strategy to life on a chart. On screen, you'll see a candlestick sequence with two horizontal lines marking the trap zone, an upper edge and a lower edge, and below the price you'll see a tick volume panel showing how participation builds and surges. We'll walk through a long trade first, then a short trade. Look at the opening candles on the left. Price is drifting sideways inside a tight band, bouncing gently between the upper and lower edges of the trap zone. Notice how small the overall range is even though each candle is still active. This is the compression the strategy is searching for. The band height stays well within the compression factor times ATR. At the same time, watch the volume panel underneath. With each bar inside the zone, tick volume is creeping higher, rising above the earlier baseline. That's the volume cluster condition building, participation increasing while price goes nowhere, which the strategy reads as capital being absorbed inside the zone. Now watch the breakout bar. Price pushes up and closes decisively above the upper edge of the trap zone, clearing it by the small buffer, and the candle closes bullish above its open. This single bar does two more things at once. Its range is much larger than the quiet bars before it, satisfying the volatility spike requirement of at least 1.6 times ATR. And in the volume panel, you can see the bar's tick volume jump far above the zone average, clearing the surge requirement of 1.8 times. All three conditions now align, and the buy entry marker appears right at that breakout bar. This is the moment the strategy steps in, positioned for the one-sided move it expects as stop orders above the zone are activated. Follow the next candles. Price extends in the breakout direction, running higher bar by bar. The stop loss sits below the entry at 1.4 ATRs, protecting the position if the move had failed. But here price continues in favor and reaches the take profit marker at 3 ATRs above the entry. That's the reward to risk of roughly 2 to 1 in action. The strategy risked a smaller distance to aim for a larger one, letting the post-breakout expansion run. Now the market resets, and a fresh trap zone forms higher up. Watch the middle candles. Once again, price coils sideways into a narrow band, and the two horizontal edges tighten around it. The volume panel cools off at first, then starts building again as activity clusters inside this new zone. The structure is the same as before, only this time we're watching for a break in the opposite direction. Look at the next decisive candle. Price breaks downward and closes below the lower edge of the trap zone, clearing it by the buffer, and the candle closes bearish below its open. Just like the long side, its range spikes well beyond the quiet bars, and in the volume panel, its tick volume surges above the zone average. Both volatility and volume expand together on the downside. That's when the sell entry marker appears, right at the breakout bar, as protective stops beneath the zone are activated and sellers press the move. From there, follow the final candles lower. The stop loss now sits above the entry by 1.4 ATRs, and the take profit sits below by 3 ATRs. price slides down through the range and reaches the take-profit marker, completing the short trade with that same roughly 2-to-1 structure. Step back and notice the symmetry. Whether long or short, the strategy waited for the exact same three-part confirmation: a compressed zone, a cluster of trapped volume, and a breakout bar that spikes in both range and volume. The market chose the direction. The strategy simply followed its rules. And in both cases, the ATR-based stop and target scaled naturally to the market's own volatility. Of course, not every breakout follows through, and losses do occur when a move fails and price returns to the stop. Let's wrap up. Today we explored the Liquidity Trap Zone Breakout Expert Advisor for MetaTrader 5. We saw how it identifies a tight compression zone amid high volatility, how it confirms a cluster of rising tick volume inside that zone, and how it waits for a breakout bar that spikes in both range and volume before signaling an entry. We also walked through its symmetric long and short rules and its ATR-based stop loss and take profit. Remember, everything here is educational information only, and nothing in this video is financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses are a natural part of it. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to cover next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.